Hello everyone, welcome to Mastermind. Today let us learn some of the very important concepts of economy by solving few multiple choice questions. Let us get started now. First question. Recently, Reserve Bank of India has increased the repo rate. Generally, it indicates that the central bank is following easy monetary policy. It leads to increase in the interest rate of banks. Here, option A or statement A is false and statement B is right. Therefore, the right option is option 2, B only. What happens recently on in February, the central bank announced its most recent monetary policy announcement, increasing the repo rate by 0.25 basis points in February. So as of now, repo rate is 6.5%. Repo rate is 6.5% and reverse repo rate is 3.35%. And what happens? What is this repo rate? Repo rate is it's a part of liquidity adjustment facility of the RBI. Liquidity adjustment facility of the RBI has repo rate and reverse repo rate. What is this repo rate? Repo rate is the rate at which Reserve Bank of India RBI lends to other banks. So when RBI lends to other banks, the interest rate it charges is called as repo rate. The interest rate it charges is called as repo rate. What is reverse repo rate? Reverse repo rate is the reverse of this. When scheduled banks lend to RBI, then the interest rate charged by the bank to RBI is reverse repo rate. So, and you have to remember one more point, that usually repo rate is higher than reverse repo rate. Even now, if you see, the repo rate is 6.5%, while the reverse repo rate is 3.35%. So 6.25% was the repo rate in December 7, 2022 last year. However, now it is 6.5%. When this repo rate increases, it leads to increase in the interest rate of the banks, and it will discourage banks to borrow from RBI and the lending to the customers. What usually banks do? Banks lend to customers. So there will be certain processes in which banks will have to obtain loans from RBI, and banks will also be providing loans to customers in return. So when the interest rate charged by RBI increases, then the interest rate at which the scheduled banks lend to customers will also increase. As the interest rate increases, people will decrease the borrowing rate. People will start reducing their borrowing. This in turn will reduce the liquidity in the economy and demand in the market. When there is little liquidity or when there is less liquidity, what is the liquidity? Liquidity means money supply. So money circulation in the market denotes liquidity. So when there is reduced liquidity, as people have stopped borrowing from banks, and this has returned in reduced liquidity, which will in turn trigger reduction in the demand in the market. So what happens if you look at this particular process? When repo rate increases, then borrowing decreases. As borrowing decreases, money supply also decreases. Money supply in turn decreases. As money supply decreases, people have less money in their hand and the demand decreases. As the demand decreases, this leads to contraction in the economy, and it is also known as contractionary monetary policy. This is not easy monetary policy but contractionary monetary policy. On the other hand, when the repo rate is decreased, when repo rate decreases, then there will be more borrowing from the customers, and as there is more borrowing, people have more money in their hand. As there is more money in their hand, there will be huge demand in the market. So this is the part of expansionary monetary policy. So what happens usually when repo rate increases? When repo rate increases, the banks will try to pass on that increase on the customers. Therefore, the banks will also increase their interest rates. So this is the entire setup called liquidity adjustment facility. So repo rate and reverse repo rate are part of liquidity adjustment facility of Reserve Bank of India. Now consider the second question. Consider the following statements regarding the Monetary Policy Committee. Each member of the Monetary Policy Committee has one vote and only the RBI governor has a second or casting vote. The Monetary Policy Committee is required to meet at least 2 times in a year. Again here statement A is correct, statement B is false. Therefore the right option is option 1, A only. Please remember A only here. So what is Monetary Policy Committee? Under section 45ZB of the amended RBI Act. RBI Act was amended. RBI Act 1934 was amended in the year 2016. According to this section 45ZB, please remember 45ZB, the central government constituted a 6-member, very important, please remember, 6-member monetary policy committee, and whatever decision this monetary policy committee takes, it's binding on the bank. Please remember, it's binding on the bank. The monetary policy committee is responsible for fixing the benchmark interest rate. Usually it fixes repo rate as well as bank rate. The meetings of the monetary policy should be held at least 4 times a year. Please remember 4 times, not 2 times. The Monetary Policy Committee consists of 6 members, as I've already told you, and it consists of RBI governor as ex officio chairperson. He is the ex officio chairperson, and it has deputy governor of RBI in charge of monetary policy and an officer of the bank to be nominated by the central board. So it will be nominated by the central board, and with these 3 members there will be 3 persons appointed by the central government. Therefore totally there will be 6 members, and the RBI governor will chair the committee. He is the chairman of the committee. The governor, however, does not have any veto power. Please remember, there is no veto power for the governor. However, he enjoys casting vote in case of a tie. If there is a tie with respect to obtaining any decision, then this person, RBI governor, will have a casting vote. So what is the meaning of casting vote? Of these 6 votes, if 3 votes in favor and 3 votes against a decision, then the governor casts his vote as a casting vote in case of such a tie. In that scenario, whoever the governor votes for will be using casting vote to arrive at the decision. Now look at the third question. Which of the following are the instruments of monetary policy? Reserve requirement, open market operations, lending by the scheduled bank, interest rate. So here the right option is option 1, A, B and D only. Reserve requirement, open market operations and interest rates are monetary policy instruments. Monetary policies are the policies related to the money supply, and they are taken by the Reserve Bank of India in India. So it is through the monetary policy RBI controls inflation. RBI tackles inflation through monetary policy. RBI uses various monetary instruments like open market operations. Open market operations means buying as well as selling of bonds, as well as bank rate. Either bank rate could be increased or decreased. Repo rate, it could be increased or decreased to tackle inflation. Reverse repo rate, increased or decreased. Cash reserve ratio, statutory liquidity ratio, marginal standing facility and the liquidity adjustment facility. So open market operation means it is an instrument which involves buying or selling of the securities like government bond from or to the public and the banks. RBI sells government securities to control the flow of credit and buys government securities to increase the credit flow. Therefore, open market operations is a part of monetary policy. Reserve requirements are CRR, SLR, that is cash reserve ratio, statutory liquidity ratio, etc. And then interest rates are repo rates, reverse repo rates, bank rates, etc. Therefore, all these form part of monetary policy. However, lending by the scheduled bank is not an instrument of monetary policy. It is more a part of fiscal policy like priority sector lending. So these comes under lending by the scheduled bank. This is a very important question. Please note down these. Fourth question says, which of the following is a fiscal policy tool in India? Goods and services tax, repo rate, corporate tax, public infrastructure spending. So here the right option is option 2, A, C and D only. So goods and service tax, corporate tax and public infrastructure spending form part of fiscal policy. First of all, what is fiscal policy? Fiscal policy is defined as relating to government taxes and finance. In other words, fiscal policy means anything that relates to government spending and how much it brings by taxation tools. The term monetary policy is the Reserve Bank of India's policy pertaining to the deployment of monetary resources under its control. As I've already told you, monetary policy concerns with the money supply. So monetary policy is policy pertaining to deployment of monetary resources under the Reserve Bank of India's control for the purpose of achieving GDP growth as well as tackling inflation. So government spending, transfer payments and taxes are the three tools of fiscal policy. Which are the three tools? Government spending, on which sector to spend more. This is decided by the government and this forms a part of fiscal policy. Transfer payments like subsidies and other things, they also form part of fiscal policy. And taxes here are goods and service tax and corporate tax form part of taxes, while transfer payments are concerned with subsidies and other freebies, whereas public infrastructure spending is concerned with the government spending. Repo rate is a monetary policy tool and it is determined by MPC, Monetary Policy Committee of RBI. Last question for the day says, which of the following is the lower and upper boundaries of the liquidity adjustment facility corridor? Bank rate, repo rate, statutory liquidity ratio, cash reserve ratio, CRR bank rate, reserve repo and repo rate. So the right answer is option 4, reverse repo and repo rate. Reverse repo and repo rate. So what is this liquidity adjustment facility? It is again a part of monetary policy tool and it is largely used by Reserve Bank of India to control liquidity. Liquidity means money supply as well as inflation. Liquidity and inflation in the economy. It was recommended by Narasimhan Committee. It was recommended by the Narasimhan Committee and it was introduced by RBI in the year 1998. This liquidity adjustment facility helps to inject or absorb liquidity, that is, to increase the money supply or to decrease the money supply. So inject or absorb the liquidity into or from the banking system and ensures financial market stability. So there are two main components of this liquidity adjustment facility. It is the repo rate and reverse repo rate. Repo rate and reverse repo rate. Repo rate is the interest rate at which the RBI lends to other banks, while reverse repo rate is the rate at which RBI borrows from the commercial banks. So this forms the lower and upper boundaries of the liquidity adjustment facility corridor. Repo rate is usually upper while reverse repo rate is usually lower. So please remember these ones, very important economic concepts these are. You will find one or two questions on these concepts in most of the examinations. That's why these have been given to help you out. Thank you.